Hi everyone, welcome to the third episode of Founder X VC. Today, Daniel's taking a short break to focus on his work in his startup. So I'll be your host for today. And guess what? I have the great honor and privilege to welcome our very first guest of the series, and that is none other than Vanessa Ho from Fintech Nation. Vanessa, welcome to the show.
Hi, Lance, and hi, everyone. Thanks for having me on this. I'd love to introduce myself.
Yeah,
I'm
please.
Vanessa Ho. Yeah, and my background in the startup and the venture space started back in 2018, 2019, when I took my first step at starting a company. It wasn't really from building a cool, sexy startup. Back then, I didn't really know what this space was about, but it was really from solving my own problems, especially when I was already in the entertainment industry as an artist or as a social media content creator. And I started a fashion subscription company, uh, perhaps similar to Style Theory, but focusing on the regional brands, something along the lines of like circular economy, sustainability. And then during COVID, the company failed and we closed shop. Um, and we decided to part ways, but I still wanted to be really involved in the startup ecosystem. So back then, I was in NUS, and alongside me were my friends who were all starting their own companies. Some were in gaming hardware, consumer brands. Some are still in the process of building the company. Some have failed as well, but we're still very involved in the space where we want to support other founders as well. So we came about to start an angel network called NUS Alumni Ventures, where we had the privilege to work with Bansi quite recently as well. So this was back in June 2020 during COVID. And to date, we have built an angel network of about 100 angels who are all NUS alumni or NUS affiliated, and they all come in with the mindset to support and help founders or train investment analysts as well. And since then, one of our first advisors, Varun Mittal, he's now C-suite in Singlife, the insurance company. We came out to do something more fintech focused. He has a very long track record of angel investing and also being LPs at a few funds, especially within the fintech space. And starting up Singapore Fintech Association as well. And I myself saw quite a few deals through NUS Alumni Ventures. We started leading syndicates together in deals. And then early in 2023, we raised some external money, and now we invest through Fintech Nation Fund, which is an early stage Southeast Asia fund, quite sector agnostic, but our domain expertise and where we bring the most value is still in fintech.
Wow, that's a very, very accomplished track record that you have there, Vanessa.
Now let's
So
see when the companies exit.
I think it's interesting, and with that, let's get on with the main show, the Q&A, right? So just wanted to start all this off with something a little bit lighter, maybe like around the likes of what do you see as a role of an angel investor in startup ecosystems, especially let's say in the Southeast Asian context.
Yeah, I think the startup ecosystem really grew perhaps 2014, 15 onwards. And back then, venture capital wasn't really a big thing, and funding resources weren't always available. So people seek private sources of funding, like friends and family and angel investors. Now, of course, you got a lot of sources of funding for accelerators, programs, CVCs. But angels, I think, were the early supporters for founders from their 0 to 1 journey. And even till now, even though there are so many channels and early stage VCs, I think a lot of times founders might need the early cash flow to build their team, test out their product before institutional investors are willing to take a bet on them, or they don't want to dilute too early when they're still really early in their product development and proof of concept. I think I see also the angels have been very hands-on in lending support to portfolio, especially when they're in similar sectors. For example, a C-suite in a big corporate that can be a potential client to the startup, or maybe an experienced founder or exited founder who can help the founders avoid mistakes that they have made before. And occasionally, all these support could be even more thorough than what the portfolio management team of a VC can lend, because they have so many babies to take care of, especially for big VCs with huge basket of portfolio. But angels maybe have the more interest and time and bandwidth to support that. But I think beyond the practical reason being a founder is quite difficult in balancing entrepreneurship and perhaps taking care of their family, and dealing with rejections. And oftentimes, angels are like individuals who can provide the support pillar or listening ear in other matters as well. And it can get quite personal, and it's easier to build a deeper connection or like a deeper fallback when you need a listening ear and emotional support than, say, an institutional fund where you may not be able to be vulnerable in front of. So I think that is like the softer aspect and the value that angels bring in that we don't really talk about as well. I also see a very strong roles in like angel networks like NUS Alumni Ventures, Bansi, and many other angel networks in Southeast Asia as well, where angel networks can share deals across markets so that you can leverage on different market expertise. And even angel networks themselves can be quite successful in helping startups raise fund. Like in our recent demo day that we did with you guys in Bansi, where almost 100 people turned up in that demo day, and $200,000 was the largest ticket size that came into one of the presenting startups. I think angels aren't just like small tickets, small value, but we have to think bigger, right? Where a lot of angels come together can be very significant in funding and support as well.
Indeed. So it's a little bit like what we see these days where, back in the days in the US, they have this angel-less syndicates going on, right? And we're starting to see that happening here a lot more. I really looking forward to the development of that kind of funding where you have a crew of angels coming together and supporting the founders as a group, right? Without
exactly.
taking like,
or even like subject matter expertise, right? We were just discussing about health tech. It would be so useful to have angels who are maybe researchers and doctors who can come in to learn that subject matter expertise where maybe your institutional funds are more of generalists and may not be able to support in that product development journey.
Indeed. So, in this funding winter, right, there's this whole crash in the amount of capital that's going into startups. So they just wanted to have a little, and I think people are getting a little bit more cautious. I'm not sure whether that's the right word to use, but people are getting a little bit more cautious, right? And what do you usually what would you advise new angels, right, to take note of when they say, hey, I see a deal, should I invest?
Yeah, it's quite true because last year as a fund, we did 5 deals. This year, I was like, okay, let's be more active. We're sitting on some dry powder. It's time to deploy more actively. But to date, so far, we haven't done that many deals. We're looking at one that we are probably going to commit, but it has been less active, even for an early stage investor. I think what angel investors should look at right now, especially when there's a lot of funding winter, is to watch out for firstly, companies' burn rate. What are they burning on? Is it strategic? Is it well justified? Are they spending unnecessarily like a pristine CBD office or flashy marketing campaigns without tracking ROI? I think it's a good time to kind of see the founder's perspective during the due diligence calls, right? Are they making a shift in, say, maybe offshore hires or opening RFQs for alternative vendors or being very cautious about customer acquisition costs? And recently we were speaking to like a B2B2C fintech company, and they're spending a lot of money in buying business flight tickets to attract customers in like lucky draws. But their clients are actually other businesses. So we're just giving them feedback on like how can you offload all these B2C marketing to your distributors or clients, or maybe co-sponsor something like that with other people as well. So I think the burn rate part is important, and the founder's thought process. It's not 2022 where people can just spray money like before. I think the second part is also like the path to profitability, the break-even point. Have they done the right projections? And I think even as angels, unless there's even if you are giving a small check size, I think it's okay to ask to see like the Excel sheet of financial projections. I know there are a lot of founders who are like, you're such small ticket, like there's no point for me to give you data room for you to due diligence. But I think at this point, I think it's okay to show that you are being very cautious, and you're taking the time to do some due diligence, and it's okay to ask for data room. to dig around their financial statements and their projections as well. What about you? What advice would you give to the angels in this climate?
I think, like you said, right? First thing, it's a lot about fundamentals, right? Um, Even in the good times, I've been trying to advocate that angels should think about deals in a very fundamental way, right? It's just, and even VC should also think about deals in a very fundamental way, in the sense that it's not because I see a big name like Sequoia or some other big VCs on the cap table, I say this is definitely a good deal. Let me get in, right? Because the venture funds pretty much at that point in time, you could pretty much think of them as unlimited capital, right? Because they can always say, hey, I'm deploying out of fund two. If I don't have enough money, I can do fund three, I can do opportunity fund one, I can do opportunity fund two, opportunity fund three, right? They can keep raising new funds to back you up. But as an angel, our resources are limited. So I think we need to be a little bit more cautious in terms of like what are the things the founders are spending on, what is the kind of burn rate we are talking about. But more important, for me, what is very important is about understanding the founder as a person, right? Because at the end of the day, it's someone that you are probably, as I like to joke with some of the new angels I talk to, you are getting married to the founder of sorts, right?
Yeah, correct. And I
And
think also in the
yeah.
funding summer, a lot of times as a personal, like I said, individual investor, I did a lot of tag along where I just trust like the lead angel in a syndicate, and I'm like, okay, you do the diligence. I'm just gonna trust you. I'm gonna follow on a check. But I think since last year onwards, I've been very cautious, and every deal that I'm interested to go in as an individual, I do a DD by myself and I understand the company by myself.
Mhm.
Because then now, looking back, right, a lot of the times during the hype of like the uh, venture capital and angel investment craze during the startup summer, people are just spraying checks. But now I'm like, okay, every deal that I do, I must understand it very, very thoroughly
Mhm.
before I commit.
Sure. So as a lead on to that, I think a lot of times in the other market, more developed markets that I've seen, right, angels tend to help the founders kind of start their companies, pretty much like a founding investor kind of position, right? So what do you think angels should what do you think when angels receive a deal that is a startup, that is a pre-revenue company, they're probably testing out a couple of products, um, making a couple of pivots along the way, maybe almost zero revenue, right? Maybe a little bit here and there. So what would you say to angels or founders of those companies, like when they are trying to raise capital from angels?
In pre-revenue companies.
Yeah, yeah.
Okay, I think it varies sectors to sectors. Before going to sectors, I think at pre-revenue stage, right, a lot of times the product is probably still in iteration, and you would probably rely on the team to adapt and iterate before finding the right product market fit. And I think how we know that you have achieved the product market fit is when it's proven when people start paying for their product. And that's like going back to basic as well. In the first or second round of investment, it's really going back to the team and do they have the right track record, the balanced team with both technical and commercial skill sets, and also access to the right networks to scale up as well. But I think going deeper down into like different sectors, we're talking about health tech, but beyond health tech, there's like say biotech, advanced material, food tech, deep tech, those sorts, right? At pre-revenue stages, sometimes revenue comes in years and years later. The startup life cycle is a bit longer than other companies that are like e-commerce, SaaS, etc. I would look at maybe IP and patents, right? Is it like patent pending or already they already have a couple of patents that are valuable? Do they have the right hires to commercialize it or have a clear strategy to commercialize it? Many times we see a lot of like strong researchers and subject matter experts, especially in some of the health tech and deep tech deals that we see at NUS Alumni Ventures. They lack the business development skill sets to complement their expertise and bring innovation to the real world. So while they're pre-revenue, which is fine, given that they're more of a product IP play, do they have the thought process to make sure they hire the right person, maybe even a fractional chief commercial officer, right? Or a BD team or a distributor for a clear path of monetization. And then if you look at other sectors, there are like SaaS, AI, data, fintech. If they're pre-revenue, do they have anything unique or proprietary, or they're just building features? But even if it's nothing unique, which is okay as well, because there are a lot of problems, especially in Southeast Asia, that are not solved, especially in developing markets. Do they have a good and strong pipeline of proof of concepts of clients? So then I'll look at, do they already have signed letter of intent with reputable clients? And that's like a signal that revenue is coming in, but maybe in the next few months or year, especially where the sales cycle can be quite long, perhaps in maybe corporates or financial services as well.
Oh, interesting. So now that we have covered a little bit about the funding winter, a little bit about like really early stage companies, it's really unfortunate, but I have seen a couple of term sheets that have come in for certain founders.
What's the
And
craziest terms that you have seen? I'm curious to hear.
oh, um, I've heard of all kinds of weird terms. Um, Anywhere from, in terms of preference shares, you're talking about, I've seen things like 1.5 times participating. If you are talking about convertible loans, it's crazy interest rates, like 1% per month compounded, and then the discounts get heavier and heavier as time goes. All kinds of weird terms are starting to.
Correct. And sometimes it sabotage the startups in the subsequent rounds, because then maybe other VCs don't want to come in that round when the previous VC gets such a heavy equity discount, right?
Yes. So, when angels, especially new angels, when they are starting out, right, they usually say, okay, the startup is looking for 300K. This person probably has a mil to spare, right? Of risk capital to spare. And he said, thinking, okay, the guy needs 300. I'll take 200. Then I will try to dictate the terms and say things like, you know what, I'll give you 200K. I want, let's say, 40 to 50% of your company, right? Because you put in, let's say 150, but you have some work, so I give you credit for that. I throw in 200, so I think let's split 60-40, right? So these kind of very unfavorable terms, what are your take, and do you think, how would you advise angels who are actually writing these kind of terms and offering them to founders?
Yeah, actually, before going into terms, I like the last point on the dilution part. A lot of times we see great companies, great product, great traction, but the founders are either people maybe who are ex-bankers who are new to the venture scene, or very young founders who just dilute themselves way too much even before their seed round. And then when they actually open their first a proper equity priced round, we realize, wow, they don't have like that many shares already. Like they're less than 50%. Is that's a big problem within the founding team. And we're like, okay, that's big red flag. Although you can like everything about the business, but you either have to buy back shares, but where's the money going to come from? Or like, why did you dilute, and who else is in the cap table? So that's one of the biggest red flags. It's quite unfortunate because a lot of these companies are actually very legitimate, very investable companies. Just maybe they're new to the startup and venture space, or maybe don't have the right advisors for it. But speaking about like very bad term sheets and unfavorable terms, yeah, so like high liquidation preference and multipliers can be really unhealthy for the founders. Can you imagine, like the founders spent all their life or most of their youth building the startup, and upon exit or liquidation, they get like the scraps and sloppy seconds, and the investors who sit at home just managing and whacking the founders get most of it. if I think about it and you empathize with the founders, you would know that I think it's fair to find a middle ground.
Mhm.
There's also anti-dilution protection, or maybe even conditional terms and target for startups to hit by a certain timeline that have to be negotiated. I think generally, as an angel, I would take reference from the syndicate lead or potentially from a VC lead if there's VCs in the round already. But I may not expect the same terms as an institutional investor who puts in, like, say, 10 times or more money than an angel, such as voting rights. If you're a small 25K ticket, don't expect voting rights when the round is so much bigger. I think also from the founder's perspective, if you're raising from like a syndicate lead or VC, there should be a time limit to the no shop clause. A lot of times, syndicates or VCs might want you to have a no shop clause for quite a long period of time. But then having this time limit also makes sure that both parties are accountable to commit and follow through the investment by a certain timeline and avoid opportunity costs for both the founders and the investors themselves. It could be an angel as well. And I think overall, from the startup and founders perspective, startup founders and the angel investor perspective, it's really not a zero-sum game, like perhaps in token investment, right? Where I think agreeing on fair terms is possible. You can have something that makes sense and is very lucrative for an angel investment, but also fair to the founders, especially when this is just a start of a 5 to 8 years relationship. Do you really want to squeeze the founder dry so early on and have this tense relationship for the next few years? So I think it's okay for both ends to understand what each provisions in the term sheet means and negotiate on terms that you care about, but compromise on the ones that you may not care about as much. In my angel network team, we take turns to step at the term sheet, and we may not be legal professionals, but sometimes we know enough to spot like dirty term sheets from, say, maybe a lead VC or a lead syndicate. And then in complex cases, we also seek legal advice. And here's like a hack for a lot of angels, right? A lot of times our lawyer friends are interested in angel investment. Maybe they don't have the time to actively source deals, but they're keen to partake in the round. And that's where you can get complimentary legal advice sometimes, maybe, right? If they co-invest together with
Good
you in the
idea.
syndicate. Yeah, so then you have professional lens to review the term sheet as well.
Yeah. So I think it's important for founders to like understand a lot of these terms. And where do you think they could go around and, like, hey, this looks really unfamiliar. I've not really seen this kind of terms before. Where do you think they could take reference from, like, for founders who are a little cash constrained, trying to, keep as much money in the bank as possible so that they can run their business, right? Do you know of any particular resource networks or something that they can go to?
Yeah, I think three things. One is Google and online already have a lot of resources on, like, what you say, poison term sheets and examples to avoid. So being well read up on that is useful, especially before you open a round. Second is, I think, having a good network and support circle of other founders, especially the more experienced founders who have been through maybe a few fundraising rounds. I think they would be able to lend an eye because they've seen tons of term sheets. They can even show you what they've signed and what they've rejected. Those are like your mentors in the industry that you can tap on. And I think right now a lot of founders are very open to pay it forward. Even maybe people who are starting companies in the same sectors. I think in Southeast Asia, or at least in Singapore, people are very collaborative to lend support. Having lawyer friends, lastly, is the most important thing as well. And maybe getting them started on angel investments, and then they would be interested to see things like your shareholders agreements, term sheets, etc. Even resources like this podcast, for example, to get advice from angels and other founders would be really useful. And what about you? Are there other useful resources that you've seen out there?
I think there are a few from like a couple of accelerators, VCs, I think SVCA publishes quite a bit of model subscription agreements for, like, for example, the convertible notes. They have the care sample, and then they have like your Series A sample, seed sample. So you could potentially take some reference of that. And then they have like the venture capital lexicon that kind of tells you a little bit more about like each term. What do they mean? How are things being calculated? And then if you're just doing like a group of angels, they're probably going to sign a safe note YC is your best friend, right?
Yeah, yeah.
Y
Just take
Combinator,
templates and what's proven. Yeah.
right? YC is your best friend. So go there, just type Y Combinator save in Google. It'll pop up probably on the first page. You can always find something like this off the shelf, right? So I think there are quite a lot of off the shelf templates that as a founder you can start with, and then after like Vanessa you mentioned, right, having a good friend who's a lawyer just to proofread to in case certain terms don't apply, right? Because let's say if I take it from YC, it's gonna be very US centric, and
Correct. And I think as a new angel, it's useful to join angel networks because you have a lot of other seasoned angel investors who have done plenty of deals, seen plenty of term sheets where you can just tag along. And you may want to focus your time and energy on maybe your day job or like sourcing and investing in more deals than the nitty-gritty of a term sheet. So I think joining a syndicate is very useful, which is really why you pay that management fees or that carry fees, is because that person is doing all the dirty work to protect your money. I think that's very what it is, very well justified.
indeed, I mean, and a lot of them, because it gives you a lot more rights in the sense that, because now as a bigger check, right, collectively you have a lot more negotiating power with the founders, right? So like it's kind of interesting because one of the deals I did, I wrote a very small check. It was like a 25K sing check into a startup that was in its seed round. The syndicate was about $1 million. We could even negotiate for the syndicate lead even negotiated for a board seat
Wow.
on the startup. So it's one of those things, right? You kind of pay a little bit more fees, and then you make sure that you get a lot more information rights. Um you sometimes can influence the founders through your syndicate lead, right? Just to say, hey, by the way, I think something is, or I think this particular move could be potentially risky. You may want to ask the founder what's going on, kind of thing, right?
Yeah, correct. And it's not just the first term sheet that you sign, right? Subsequently, as they go along other fundraising rounds,
Mm-hmm.
you might get diluted, you might have to review the shareholders' agreement. So it's not like just one time you're just gonna sit back and relax. Sometimes you have to sign off certain
Mm-hmm.
other agreements. It's very useful that the syndicate lead to vet through that before you have a step at the term sheet, because it
Mm-hmm.
takes a lot of time. And honestly, even for myself, I may not understand all the provisional clauses as well. So it's useful to have like a syndicate lead to take charge of that.
Yeah. So do you envision like any like angels taking an active role in the company's growth? If yes, what kind of active role? Is it more of advisory, mentor, or is it a lot more like, hey, I want to be involved in the day-to-day management?
I think there are two types that I see, or three types actually. With one, I won't talk about are just people who write a check and forget about it and disappear because they angel invested in too many companies, or maybe they're building their own startups, which is
Mm-hmm.
very fair as well.
Yeah.
The second one, which is kind of like the light to medium commitment kind of angels, would be people who are probably still building their own company or in C-suites or have a professional job like they're lawyers or doctors, for example. But what they lend is two things, right? Subject matter expertise, especially when you're doing, like, say, deep tech kind of work,
Mm-hmm.
research heavy kind of work, then they may have the experience to advise you on your product development process. But second, which I see more common and I tap on the most, is the network. Um, Especially when you're opening new markets. You're new to, say, Hong Kong and Thailand, and you need introductions to other
Mm-hmm.
founders and investors or potential clients there, or you just need the referrals to later stage investors or potential clients. That is the most useful. And I think a lot of founders, they don't leverage on this well enough. Um, how we see it in Fintech Nation Fund and even for myself is I have group checks with different founders where, like, I may or may not have invested in them. Some of them I like, but maybe too early, or I just want to keep in view. But time to time they'll just ask, hey, do you know anybody in, say, in Jakarta that might be interested in this? Or would you be able to refer me people from this sectors?
Mm-hmm.
And many of the times nobody will say no. unless they're like not nice people. But even if you haven't invested in them, like people are just generally willing to open their network. I think it's a very Singapore culture thing, maybe less so in other markets where people are more gated. But founders just have to open their mouth and ask, and resources and networks will be opened up. And that's even before the money comes through. Even in the process of the angel considering a deal, feel free to just test it out also, right? Ask, oh, can you refer me to this, and also test out whether the angels are willing and interested to help you in that journey, to see whether this check might be strategic or not. The last bit I've seen, especially in my role in Party Post, where I do partnerships, right? It's an influencer advertising platform across 8 markets, close to growth stage already. We recently closed a convertible note round, like a A+ round. And we had one angel investor who put in, say, I think about 50K or so check size. But what he really brought in was $500,000 of deal with one of
Wow.
our now largest client. So it's not just about the check size, right? But this person was really vested to support the company's growth, even driving our top line with such awesome introductions of clients. And then eventually he was so passionate about his he's such a strong believer of our business, plus he has additional bandwidth after he left his previous role, that now he leads the country head. He's now the country head in Thailand, leading a lot of the operations there, helping us find the right hires, talking to corporate venture capital there. So angels can really take a very hands-on approach if they have the bandwidth for it. Could be a fractional position, or even leading market entry in a new market where this angel has the right network and resources for.
Indeed. I mean, we've seen, but on the flip side, any kind of angels, you probably as a founder, you would say, you know what, let me take a step back and say thanks, but no thanks.
Yeah, correct. And I think this kind of journey also evolves if you can connect with the angels enough as a founder, and also be very open and transparent on not just your highlights. You know how investor reports quarterly or monthly, you share all your highlights. Oh, your company did well, this is what we did. But I see what founders do well is also especially for angels, right? You share some of your lowlights, right? It's okay to be vulnerable, to share like, okay, these are the things we're struggling with, and these are us. Can you help us, maybe connect us with the right clients to try proof of concepts with, refer us potential new hires. And that's where you can really get the most value out of the angels. So I would say like founders who are open enough to share some of their lowlights can really receive the most value out of angel investors, because they don't know unless you open your mouth and ask and share your problems.
Cool. All right, Vanessa, I really think that was such a great session. Appreciate your time and insights. Hope you enjoyed the session as much as I did. Right. So for our
Thank you,
viewers,
Lance.
thank you. Thanks for joining us again. Right. So for our viewers, if you have any questions on the topic, feel free to ask us in the Google form in the comments down below. Right. Remember to comment, like, share, and subscribe, and I'll see you in the next video. Take care and Godspeed.